Hello, everybody. This is Bob Klutsis, President of All-Star Financial, here for the All-Star Financial Quarterly Review Second Quarter 2013 webinar. We are entitling Slow Ride, Take It Easy. All of you may remember Foghat as one of the great bands of the 70s. We're kind of going to take a little bit of a theme on that. Before we get there, Bob's Corner today is focused on our moniker, which we've had for many, many years. It's not how much you make, it's how much you keep. We really look at the continued volatility as creating opportunities for our process and discipline to actually benefit you more than it hurts you. You get a better compounding effect of your dollar whenever volatility is minimized. When you look back just at the second quarter, the Russell 3000 was down 10 days, more than 1% in that day. All-Star Financial composite portfolios added together had only 2 down days of 1% or more in the second quarter. So again, volatility makes us look that much better. When we look at kind of the market overview, that slow ride, take it easy mentality, the slow global growth is still continuing to be there. Economic news hasn't been spectacular. But equities did rally in the second half of the second quarter as the Fed created more ups and downs with their policy potential changes and monetary policy potentially being tapered off from that $85 billion a month. Created a lot of volatility. It also created interest rate spike to about 2.7 on the 10-year relative to about 1.7 one quarter ago. World banks are also in a similar buying program of bonds and trying to fund their economic stimulus through what I define as funny money also. And the big question for us is will a truly healthy economy emerge from these tactics? And I think that question is left to be answered for perhaps many years to come. So our view on life is, hey, slow ride, a lot of uncertainties. Take it easy, be patient. You look at the U.S. economy, searching for better news is kind of the one thing that we look at. First quarter GDP revised down from 2.4 to 1.8. That obviously wasn't what we were looking at. What we did find, however, is the housing recovery is continuing to take hold. New construction is up 29% in the first 5 months of 2013. Existing home sales have jumped 14% year over year. So again, nationwide prices are up. All of those things bode well. In addition, the auto industry has really benefited with over a 10% rise in purchases of sales of new cars over the last 12 months. And again, I think part of this has to do with the pent-up demand where people just didn't buy. They put off that auto purchase, and now with things feeling better, they're buying a little bit more frequently. Banking sector has been up, obviously, with mortgage lending and consumer business lending has been up gradually. The broader U.S. economy, however, is still sluggish, and unemployment is really still too high at 7.6 to fully have a basis for economic growth that's internal. The benefit of all of this, however, is that inflation has been very low and staying at less than 2%. When we look at the economy going ahead of ourselves, we still think that slow and question mark is there because we need healthier consumer spending. Jobs would help that consumer spending issue. Sequester cuts have reduced the deficit from about 8% to 4% deficit this year, which is great. Helped the S&P upgrade the U.S. credit. But again, the Congress is still kicking the main issue down the road, and that's the fiscal policy that we need to address. One of the things that beyond all of the confusion and irresponsibility of our politicians, our energy boom, particularly in North Dakota, has really helped reduce the volatility of our energy costs domestically. In the bond market, staying ahead of the Fed is really the statement we're making, where higher interest rates hurt returns this last quarter. We saw U.S. credit bonds, corporate bonds down almost 3.5%. U.S. high yields did a little bit better, down a little bit less than 1.5%. Government bonds almost 2%. Mortgage backs right at that same level. Long-term governments did the worst at almost a 6% negative rate of return. Barclays aggregates, including both government and corporate, was a negative 2.32. Global bonds, even worse due to the strengthening U.S. dollar. So not only did interest rates spike up internationally also, but the dollar appreciated, which took some value away from those. So we had the broad market index on global bonds was down 2.79. Emerging bonds were down a little bit over 6%. And something that's supposed to, in a rising interest rate environment, protect you, the Treasury Inflated Protected Securities TIPS lost 6% as well. So again, no place to hide on the bond side of the world, although we look at going forward, and even though this 30-year bull ride is about to be over, there's still a place, and we believe there's going to be a recovery from where it was. We think the Fed and people reacted or overreacted to the Fed. We expect interest rates to come down, and there'll be some recovery on the bond total returns here this quarter. We still think that bonds have some type of appropriate asset allocation within everybody's portfolio, but it's what kind of bonds that you have is really the key. We have a lot of good fundamentals that are going on in our bond exposure. Our high yields still have very low default rates. Corporate balance sheets are really good. The emerging credit bonds got really hit hard this last quarter, but again, it's up and against the actual upgrading of all of those bonds and actually getting better, but the market took them down worse than the domestic. Domestic stock market, we look at basically the U.S. set the pace there. About 4 weeks before the end of the quarter, the Russell 3000 was negative 3%, ended up positive 2.69% on a late rally. Some of that has to do with the strong dollar. Some of it has to do with, obviously, the idea that the economy is getting better and they may be slowing down the emphasis on quantitative easing. Large caps did better than small caps this quarter. It was opposite last quarter. Value did better than growth for the second quarter in a row. Sectors that were up, financials, positive over 6%, consumer discretionary over 4 or 5, and healthcare over 4%. Those were really the laggards last quarter, so in the last 3 quarters they kind of shifted. Utilities did better last quarter, materials did better, and energy did much better. So we're kind of seeing an on and off switch here as far as what sectors do well compared to each other quarter by quarter. When we look ahead on the domestic stock market, we look at corporate earnings, which are really going to drive the true valuation, and we think that the market will be tempered because earnings will continue to slow. Growth stocks are undervalued right now, particularly on the tech side, because businesses have basically slowed their spending with the uncertainties of Obamacare and obviously the uncertainty of our debt. Large cash reserves keep growing. Not a good thing again. People are still on the sidelines. The average corporate coffers right now, or not average, but the total corporate coffers are almost at $2 trillion in cash right now from about $1 trillion in 2009. So people are still on the sidelines. We thought merger and acquisition activity might be picking up, but it's not. So again, an issue there. Foreign stocks, the world of question marks basically. U.S. outperformed. The question for us would be, why would that be the case? And again, some of that is dollar denominated, but also some of that is that the European problems are still there, which has now affected some of the emerging markets. We think that 12% unemployment on average in Europe, 7% in Germany is the best that you see there. People basically focused on U.S. stocks because of that. And even though the performance was better domestically, we think the valuation is better internationally. Europe was down about 0.51. EFI, which includes Europe, Asia, and the Far East, was down a little bit less than 1%. The S&P Global BMI, which includes all foreign as well as domestic stocks and bonds, combination was pretty flat at a negative 0.27. And emerging markets, which hurt us, emerging market bonds were down about 6%, emerging market equities about 8%. But again, our 20 to 30% exposure in those negative 6 and negative 8 categories, emerging bonds and emerging stocks, will come back to benefit us in the next 6 months for sure. China was also down on a negative 6.76%. If we're looking ahead, we still think, as I said, it's a good buy. If you look at the second half of 04, 06, 10 and 12 was much more favorable to the international and specifically emerging. I think China is still going to pursue that active stimulus. Unrest in Turkey and Brazil will probably fade. Europe is showing signs of bottoming, and we think Japan's reform should help in the long term also. So in summary, hopefully this is beneficial for you. The word of the month, though, has been tapering, with the idea that the Fed is really not ready to take the foot off the pedal. There's some confusion in the market that we took some hit in the market, and then we had an appreciation when people started to kind of read into his statements. Market reacts really today on a lot of short-term events, and that is indicative of a late, long bull market, late-stage bull market. And we want to make sure that you understand that we have taken chips off the table, been more conservative. We have underperformed now for 6 months. But again, we love that because we know that when times get tough, that 20 to 30% exposure in the alternative assets is going to come back to benefit us. Signs of the end of the bull market, again, as I mentioned, average investor, because of fear and greed over the last 12 months, made about 2% when the market was up 4 to 8%. Do not let greed and fear rule in your decision-making process. That is where people get confused on what makes them successful. So, in 3 words, take it easy. Slow ride to start. Take it easy, basically. Have patience. Know that what we're doing is going to not outperform in the up market, but will outperform in the down market. And over the last 14 years, we've proven that out drastically. The previous 10 years to that, we almost have a 25-year track record. It even proves out better. So as a summary, we want to thank everybody. We also want to inform you that we do have a new website and a new newsletter format. Please explore that. Give us your feedback. Our goal was to make it a little bit more easily read for you, as well as assimilating and getting you more information in a shorter period of time. So we thank you for your continued trust in the All-Star team. Remember our referral program, and make sure you give us a call if there's anything that we can do for you or for any friend that you might know. Have a great day, and as always, be blessed and be a blessing.